All right, now, the way that things have moved over the last 1 week, it's just been, what, 4 days, less than 4 days since the presentation of the budget, and already we've moved past it. But then it bears speaking about in the context of everything else that's happening. And to do that, let's speak to Upasana Chachra, who's the Chief India Economist at Morgan Stanley. Upasana, thanks so much for taking the time. They say sometimes a lot happens in the span of a day or two, and that indeed has taken place this week. What do you take from the budget that is still contextual, given what we saw on Monday night, which is the signing of the trade deal, and everything else that has happened in the near term and heading into policy tomorrow?
Yeah, I think a lot of events in this week already. And, from a budget perspective, I think the key takeaway that we should keep in mind is the budget is pretty supportive of growth. The fiscal deficit at 4.3% of GDP is only 10 basis points lower versus where we will end this year. So this is like the shallowest pace of consolidation, especially in the post-pandemic era. And that gives a lot of freedom to the government to sort of push growth higher through the year. CapEx spending continues to get prioritized with growth tracking at 11.5% and CapEx to GDP expected to go up. Spending on key areas like defense, roads, railways is all good news from a infrastructure push to growth perspective. So I think cyclical recovery driven by this budget, which has been, sort of prior or balancing both fiscal deficit consolidation and CapEx is one of the key messages. And the other one, I think, is again that the structural measures continue. If you look at steps taken to sort of build on the past steps for manufacturing sector, then steps taken to prioritize services sector through tax clarity, certainty, and the tax holiday for data centers. So I think all in all, still, the budget's relevance for fiscal 27 is still pretty much there when we look at the year ahead outlook.
Upasana, hi, Tamanna here. The 17 lakh crore gross borrowing figure in the budget on that day, on that Monday was, matter of discussion. That Sunday and Monday was a matter of discussion, and whether it was higher than expected. Does some of the fiscal math now does it now need to be relooked at after the India-US trade deal has been struck? Because that happened right after. Does that change some of those calculations now that India's tariff to the US is gone from 50 to 18%?
Yes, so I think one from the gross borrowing number, yes, it was on the higher side. Expectations are probably at the upper end of 16.5 trillion. What we got was upwards of 17 trillion. But again, I think the government has been a bit conservative when we look at the deficit financing math. Pretty much well known by now. The small saving growth expected for this year is pretty modest at just 4%. So I think there's still some buffers on the borrowing side. The numbers through the year may not then eventually remain as high as what was indicated on 1st Feb. And from a trade deal perspective and its implications on the budget, I wouldn't say that there are any major direct implications that I think we need to sort of do to rework the budget math. I think overall it does improve the growth outlook, especially the overhang of uncertainty that goes away, and then that creates sort of tailwinds for cyclical recovery. So we should wait and watch for the finer print and details, and also then see how the data pans out, because in the last year, yes, external demand was a dampener, and if that can change this year through this trade deal with the US or with the EU now, which are most important trading partners for India, that can then improve the cyclical growth outlook and so have implications on the positive side on the budget.
Upasana, the question I think a lot of investors in Indian equities will be asking is whether this spate of good news will actually translate. And so from that perspective, should you be structurally positive on Indian equities, particularly given the underperformance of 2025? What's the view here?
So I think the short answer is yes, we should be constructive on Indian macro and Indian equities, I think both from a cyclical and a structural perspective. I think what we can take away is that if you look at the policy actions by both the central bank and the government over the last 12 months, it's surely supportive of growth. So you've got fiscal deficit impulse coming in, fiscal impulse coming in through the form of lower taxes, both direct and then indirect through last year, higher capex spending budgeted for this year, and the monetary policy easing through lower rates, higher liquidity, and also regulatory easing. So I think there's a lot of stimulus in the pipeline, which is helping the growth recovery. So if you were to look at high frequency data, that's already showing that there is some amount of recovery building up. And I think when you think about equity markets, the problem has been low nominal growth in the last year. And I think the key takeaway is that nominal growth is set to expand from here on. So in our view, nominal growth would probably end this year at fiscal 26 at about 8.4%. I think for next year, the number even in the budget is 10. We are similar, but if you think about like the quarterly exit run rate, it would be higher. So I think a number like 10.5 by March 27. So you have like a 200 basis points of expansion in nominal GDP, which is, I think, critical from a equity market corporate earnings perspective.
Upasana, on that note, I think a lot of people will be happy to hear some of those last things that you spoke about. Thanks so much for taking the time and for speaking to us. Pleasure speaking with you.